We are talking about how real estate can compound your investments today. That's next. Hi, we're back. Michelle and John with Living in Midwest Life. We are talking about real estate investing today, something John knows very, very much about. And we want to talk about how real estate can truly compound your investments in a very different way from basically anything, right?
Yeah, well, real estate is a very unique vehicle for you to invest. And there's so many great opportunities in real estate where you can invest to take care of, really leverage your tax advantages, leverage your debt, and understand how that compounds together to create just a higher rate of return than you're going to find in many other investment strategies.
Well, so why don't you take us maybe between an example of if someone were to buy, like you and I were talking prior, a $100,000 property versus putting that money in some other account?
Yeah, well, if you think about it, one of the things that real estate provides is a leveraged investment. And what that really means is if you're going to buy a piece of real estate and you put $10,000 down on that real estate, and let's say it's a $100,000 asset, you just purchased an asset for $100,000, but you only use $10,000 of your own money. Now, financing may not work out that way, but we're using that for just simple numbers. So you put $10,000 in, and let's just say that investment generates $1,000 of return after you pay everything, and at the end of the year, you get $1,000 back. Well, you just earned $1,000 on your $10,000 investment. And so that's a 10% rate of return against your $10,000. As opposed to if you were to take that same investment and you were to buy a stock, and it's maybe going to make 5 to 7, maybe it's 10%. And you actually have to put the $10,000 in, and it would generate maybe $700, or let's just say it's the same $1,000. You get that $1,000 back, and you've got a $10,000 on your 10 grand. In real estate, you've levered that gain. So you have a $100,000 asset that is also appreciating at, let's say it's 3%. That's a pretty standard. In our market, it has been traditionally much more than that. But you've got 3% gain on $100,000. So now you've made additional appreciation of 3% on that $100,000, and you've used only $10,000 to do it. So you're levering up, and if you look at that, now you've made $4,000 on that $10,000, which is effectively 40%. So again, using that leverage allows you, a lot of gives you a lot of potential gains that you otherwise would not have in other vehicles. The other thing that comes in is there's a lot of tax benefits for owning real estate. So you might actually generate $1,000 of cash flow with that property, but your tax benefit, once you write off the debt that you're paying, also the depreciation of the asset, you might be able to depreciate, probably roughly, $15,000 of depreciation on that asset. You made $1,000 of cash, but because of that depreciation, it will show no taxable gain for you. So because of depreciation and because of your leverage, you're able to generate more cash with no taxes and more gains because of the leverage than you would otherwise get in an investment.
And you have a physical asset as well.
Correct.
To do other things.
And people kind of talk about that like gold. You've got gold as the physical asset. When you buy a company, sure, you have a stock that you've bought, but you don't make any decisions with that company. That's not yours to manage in any way.
Right?
Real estate assets are physical real assets. So certainly, I think there's some liquidity issues in the real estate market. You have to go and sell your real estate asset, whereas stocks and bonds are much more fluid in their ability to buy and sell. So there is some security changes there. You're not able to just like tomorrow go sell your property and call it a day. So it's a little bit longer term investment, and it does take a little bit longer to actually make that all make sense. One of the major things that you're actually able to get from real estate assets is the long-term investment in a real estate asset. The longer you own it, technically the asset starts to perform less. If you put $10,000 in initially, right, you get $1,000, your return is on $10,000, $1,000 is 10%. But the next year you've paid down your debt and the appreciation of the property has gone up. So now it's considered what we call return on equity. So let's just say it went up by 5%, so now you have a $105,000 asset, and just for ease, we'll say that you paid $5,000 in debt down. So now you have an additional $10,000 inside of that asset, and you've got, roughly 20% of equity. So the next year, you're actually maybe getting the same $1,000, but it's on $20,000 of equity. So your return on that is actually dropping. So over time, what we try to encourage people to do is as those asset values go up and you pay down the debt, you can do an exchange. And there's an incredible tax advantage using what's called a 1031 exchange, where you buy another piece of real estate, you take all the gains you had in that real estate asset, you put it into this exchange, and you use it in another purchase for another real estate asset of like kind. And when you do that, you defer all of the gains that you had in the previous investment, and you're able to buy that new asset. And what you end up doing is increasing your gains on that next one by putting money down and moving it on to the next investment. And it's levering up your real estate asset. So now instead of owning a $100,000 real estate asset that may be appreciated to, let's just say it's $200,000, you take that $100,000 of gain that you gained on that property, you roll it into your next one, maybe you buy a $500,000 property, and you get more depreciation, you generate more cash, and you're just levering up your real estate assets as you go. And over time, that compounding effect can generate millions of dollars in asset revenue.
Very well said. And as far as a 1031 exchange, we will do a separate video on that as well. And we're going to break that down. You've got a great spreadsheet that you can use, and we'll show you how that works. If you're in that situation where you need to maybe think about exchanging properties, you're going through that right now. We're going through this exercise as a team, just listening to you figure out what to do with some of your properties, right?
Yeah, I'll tell you what, return on your initial investment in year one and then return on equity over the long term in real estate is something that a lot of people don't fully understand. And I see investors say, like, oh, I have a really great property, there's no reason to sell it. And to some degree, that makes sense. But also, as you gain more and more equity in properties and you build your real estate portfolio, looking about how you can exchange those and trade up into other investments really can increase your gains very quickly in the real estate world.
Excellent. Okay. Well, if you're on the fence thinking about investing in real estate, maybe you already have a little bit of, experience, a couple of properties. We love to chat about this. John's always available to talk. All of our contact info is below. You can always reach out, find us on social, like this page, and keep up with all the videos. And we'll be back again with the 1031 exchange video for sure. But in the meantime, if you have individual questions, reach out. Happy to chat about that, right?
Yeah, I look forward to it.
All right. Thanks again. Thanks for watching, and we'll see you next time. And again, if you haven't subscribed, do so and get those new videos as they come out. See you next time.